I'm good.
All right, so we can begin whenever you're ready, and I'll slide down the slides as you talk.
Sounds good. I'll just kick it off. My name is Chris Besler. This is my second time presenting you guys within the past year, so thanks for having me back. Just to give a quick recap of my bio, I started in my Wall Street career just over 20 years ago, right as the NASDAQ hit its peak in March of 2000, the peak at least of that time. I worked for 4 years on the sell side at a large investment bank. And then I transitioned to a private family office or a single family office, which is basically just an investment fund for one person instead of a mutual fund or a hedge fund has lots of investors. This is just one person's money that we managed. For the last few years, I should say, I've just been working as an independent trader, so just trading my own account. So I was sort of thinking about what I was going to talk about when Pete and Callie asked me to do this again a second time. And then GameStop happened. That was kind of a lot of fertile material to talk about. So I titled the presentation, GameStop, Wall Street Bets, and Diamond Hands. Ignore the crowd and trade like a professional. Trading rules to protect your capital and achieve higher returns in your personal account. And, really my reaction to seeing GameStop is just watching tons of classic investing and trading mistakes. And so my goal today is to go through several of the mistakes that I saw people making, and you can see them because people are posting everything on social media these days, so you know pretty much what people are doing. And how we can sort of learn from those mistakes and really trying to trade less like an amateur and more like a professional. And there are rules that professionals follow that amateurs really don't. And by following these rules, the number one goal is protecting your capital and minimizing your losses. And the way to make a lot of money in the stock market or any financial markets for that matter is by minimizing your losses and keeping yourself in the game. So let's kick off. I have this kind of in 5 separate sections. I'll start with a brief introduction, why we need rules. Second is a trading foundation, which will be a very short recap of my first presentation. And if you weren't on for that, don't worry. This is a self-standing presentation with or without my first discussion. Then I'll go through 10 sort of additional rules, and these sort of build upon the foundation concepts, but it's sort of rules and guidelines, more specific tools I think you can use in your trading and investing. Again, with the notion of protecting your capital, minimizing losses, which allow you to be in the game to get those high return trades when they come along. I will go through those quickly, try to save as much time for GameStop and Q&A, but if there's any specific questions on any of the rules that I have, we'll just raise it and I'll go in a little more detail. And then after GameStop, obviously we'll open it for Q&A. So you can see my name up on what Callie has right there, Chris Besler. If you have questions afterwards, feel free to email me. I should have posted this in the presentation, I just forgot. But my email is my name right there, Chris Besler, that spelling, @gmail.com. So pretty straightforward. So why do we need trading rules? And first, or investing, whatever you want to call it. But let's start off with, it's very easy to get started in trading and investing. There's pretty much no barriers to opening an account. And with Robinhood, you don't even need any money. You can open an account, and I think they give you a free share. And most people will invest their savings in some form or another. Even if you're putting in a bank account at a savings rate, you're still technically investing because you're making a decision not to put it in more riskier instruments. It's still an investment decision. So everybody is investing their savings, which obviously is very important to everybody, what you do with your money, but there's zero formal training for trading and investing. I would say, in my experience, even investment professionals, people who you would think are experts, do not receive formal training. Banks have some training, but, and I started at an investment bank, most of investing and trading is on-the-job training. And so you're learning as you go, and you're learning through your mistakes. And hopefully you can, minimize those mistakes to stay in the game. But from my experience is it's really kind of like a sink or swim learning environment. And so my goal today is really to help, give you a few more rules and guidelines that can help you with that sort of learning process, and hopefully avoid the mistakes that people make, because it's very hard to recover from big mistakes. And some of the people who have put a lot of money in GameStop at $300 plus are experiencing that right now. I realize the stock has come back, but we can talk about that later. So, more to the question of why do we need rules? So we're not giving training, we're not given really formal training, and there's a lot of misinformation out there. A lot of the popular notions about trading investing are just wrong. And trading is also unlike anything else we do in life. It's really psychology and discipline, as I talked about before, and these are very hard things to maintain and get a hold of. And what makes you successful in the rest of your life isn't really relevant to trading, right? You can do well in school by studying more. You can't do well in the market by studying more. Belief in your ideas and your convictions, that can get you ahead in life. It doesn't work like that in the stock market. And in fact, holding onto your beliefs too long can actually be detrimental, and you can, ride down huge losses. So it is a very unique environment. And the market is always trying to get as many people in on the wrong side of the trade and take their money. And that's what the market does at tops, what it does at bottoms, what you see with shakeouts. The market's trying to fool as many people as it can all the time and basically take your money. And so we need rules to help us deal with this very unique environment. And so, moving on, just sort of a brief recap of what we talked about before. Building a strong foundation, again, help you deal with this environment. The first is matching your trading to your personality. If your trading and investing style clashes with, just you as a person, it's going to be very hard to be successful. Number two is develop a trading plan with explicit rules. So I highly suggest creating a written, or, obviously not written, but in Word or whatever, Google Docs, something like that. A document that you can use to guide your trading with your rules and your strategies. I have like a 50-page document that I reference, and I'm always updating. And then, of course, you always follow your plan, because a plan is worthless if you're not following it. Number three, risk management. I've already said this. You'll probably hear me say this several times. You need to stay in the game by keeping losses small, taking your losses quickly. What we've seen with, and I have to remember not to call them DFV, but Roaring Kitty, this is rare. Most people do not make fortunes in the market by hitting a grand slam home run, certainly not on their first try like he did. The way and the strategy that you should think about for making, attractive returns over time is by compounding over time. So you want to stay in the game, and you do that by keeping your losses small. And then finally, the fourth point was mastering your psychology, really controlling your emotions, maintaining discipline, admitting that you're wrong when you are wrong, not getting upset about it. These are very important aspects of trading. Probably 80 to 90% of trading is just your psychology and maintaining your discipline. Stock selection is much less important than people think or realize. And so it's sort of just building upon those four concepts that we discussed before. And again, if there's questions on this, we can go in more detail. Sort of just, Callie, if you can scroll down a little bit to the next section. So I'm going to go through these very quickly. I think there's one or two that I will touch on in a little bit more detail, but I do want to give enough time for Q&A to the extent there is interest in GameStop. And if I have extra time, I'll go back and maybe touch on a couple other points that, I didn't go into that much detail. So these are rules that I would say professionals follow, or mostly follow. The first is learn to read charts. No one told me I had to read charts for 16 years of my career, and it was an oversight. When I say learn to read charts, you really want to be learning price and volume. I don't know to what extent you are familiar with the whole field of quote unquote technical analysis. And technically, well, I shouldn't use that, but price and volume is technical analysis. but there's a whole larger field of technical analysis that uses all these indicators. There's probably over 100 indicators. You hear like MACD, RSI. I can't even name more than that because I don't pay attention to it. The technical indicators have zero predictive value, but you will hear many people, spout this as like wisdom. But again, like I said, there's a lot of things on Wall Street that have become accepted, but are actually not useful or are wrong. And technical analysis is just one of those where there's no predictive value to it, but people will claim that, hey, this technical indicator is at this level, therefore you should buy or sell the stock. There's zero predictive value to it, so you have to be careful when you listen to these analysts. And so learning to read a stock chart with the price patterns, price action, and volume really can help you understand the supply and demand of a stock. And it can help you to understand if a stock is acting properly or if it's acting weak, or if a stock is really strong and you want to hold on to it. And so combining this with, fundamental research, at least, which is my approach, it's kind of a necessary and very helpful way of trading and investing. And like I said, for 16 years on the sell side, and then when I was in a buy side institution, we didn't look at charts at all. And it was an oversight. And a lot of people don't look at charts. They think it's like voodoo information. And again, I think a lot of that comes from the fact that the larger technical analysis field is just guesswork. But if you can learn to read the pricing, you can better spot tops and bottoms in the markets and also know when to sell your stock. And it just helps put you in a better position from a probability standpoint. So you're like, hey, that stock is gotten really volatile all of a sudden. It's probably not a good time to buy. Versus when a stock is in a tight price range with low volume, okay, it's quieted down. That's a much better time to buy a stock. That's this is a long discussion, and this is actually one of the 10 rules that I actually will talk a little bit more about. I would encourage you to, out of here, there's a couple of key points that I have. If you take 2 or 3 things away, this is one of those that I would say is a key point to look into more if you are so inclined. Rule number 2 is pre-plan your trades. Basically, don't do spontaneous trades. If one of your friends texts you and say, hey, buy Apple, don't just go out and buy Apple, right? Because you're not following your trading plan. Your trading plan should have a little bit of time where you actually research that stock. Maybe it's purely technical, maybe it's fundamental and technical combined, but you should have some thought going into it. And even people who are trading on prop desks for like a minute or 10-minute sort of a trade time horizon, they still come in every morning and they're prepping and looking at what could potentially set up, and they have a game plan. They're not just trading randomly. And that's something to realize, is that the best traders, regardless of their time horizon, are doing work ahead of time. Number 3 is measure your results. Basically, there's a saying you'll probably hear: if you don't measure it, you can't improve it. So the 3 that you need to track at minimum are your average gain, your average loss, and your win percentage rate. And I talked about this last time. I have a table at the end of the presentation. We can kind of go through if there's time. These are the 3 statistics that are largely going to determine your returns and your ability to stay in the game. So the table just shows you your ratio of percent gain to percent loss and what percentage you're right and what it takes to break even. I would say a good target is 2 to 3 times. So if your average loss is 5%, shooting for an average gain of 10 to 15%, that ratio is a good place to be or to start. And obviously you always work to improve things over time. Number 4 is study your trades. Again, if your results, the 3 metrics I talked about, are not in line, you need to improve them. Well, what's one way to improve them is to study your trades. So keep a log, written or Excel both, where you're writing down your trades, all of your justification for it, anything else that you think is relative to that trade, and include stock charts. When you enter, maybe when you're stopped out, or when you sell, and then a chart for, some time period after you sell, so you can see what happened to the stock after you exited. So look for things in common across your trades, particularly the losses, and look for areas that you can improve. Maybe you're buying too early, maybe you're buying too late, maybe you're selling too early, maybe you're selling too late, or maybe your stock selection is just needs improvement, picking better stocks. Number 5 is don't overtrade. We're in an environment of free trades. Commissions were never that much. I've been paying $1 for commissions for I can't even know how long. So moving from $1 to $0 is really not a lot. Think of the cost of your trades and your losses, not in terms of your commissions. And when you start trading more, odds are you're trading lesser setups and not as high quality ideas, which is going to lead to more losses. So really just be patient and take high quality setups. Number 6 is concentrate your portfolio. And this may be something that is more relevant to someone like me who came from, an institutional background where we would have 30 to 40 stocks, and maybe it's less relevant to someone who's younger and just starting out. 8 to 12 stocks is a good place to be. 30 is way too many. No one has 30 good ideas, and you're just diversifying, as they call it. Your 30th idea is nowhere near as good as your 5th or 3rd or 1st idea. And it's too much to follow. So 8 to 12 is a good place to be. And you can always get more concentrated than that as you improve and have experience. Number 7 is vary your trade size. Basically, don't be all in 100% invested all the time. Market conditions change from easy to hard. Right now, we're in a hard environment. So you should be in a hard environment. You want to be trading less total dollars invested, and your position sizes should be smaller with tighter stop losses. When it's a roaring bull market, yeah, you'd be fully invested, maybe even margined if you're that risky. Although, spend a few years and make money before you're on margin. That would be a separate piece of advice. And you can let your trading stats guide you. If you have like 8 out of 9 winners in a row, well, that's a good sign that the market's your trading is in sync with the market. You can make things bigger. You have 4 or 5 losses in a row, well, you should start saying, okay, maybe start scaling back things a little bit. Number 8, and this is another sort of key point. The quote is attributed to Paul Tudor Jones. I don't know if he came up with it, but it's attributed to him. It's called Losers Average Losers. And it's basically dollar cost averaging. And it's how I was taught. So I feel okay bashing it because I did it for a long time at my old job. So you buy a stock at $100, it goes to 90. Well, now it's cheaper. I should buy more. No, it goes to 100. You're wrong. Either your analysis is wrong, you picked the wrong stock, your timing on that stock is wrong, or both. And when you're wrong, you don't double down on a wrong position. You double down or add to a position when you're up. So if you buy it at 100, it goes to 103, and it's acting well. Okay, now I can add more. So add as you're right, not as you're wrong. And this is one of those Wall Street sort of truisms that everybody, the brokers do it. You'll see it everywhere. I would highly advise you against dollar cost averaging, and the best traders in the world do not dollar cost average. And I think that probably is reason enough to not do it. Number 9 is tune out the news. Most of your best traders ignore the news. Now, there's news, you follow earnings, you follow the Fed, just general market news, but don't get caught up in opinion pieces, market calls, that sort of thing. And, usually the news is late to the game. If you're making investment decisions based on the news, it's already priced in the stock. Everybody already knows it, and that's just not a great place to be timing your investments. And the final one is make trading boring. Successful trading and investing is a lot of grunt work. It's a lot of preparation. It's a lot of repeating the same things over and over again, day to day. It's emotionless sort of, no emotions is the way to successful trading. It's a very rewarding and interesting career, or again, if you're not pursuing investing as a career, for your personal wealth, it's very interesting and rewarding. And you need to treat it like a business. It's not gambling. You need to really treat it like a business. And, if you want to get, your kicks out of something with your money, go on DraftKings or go to Vegas. For me, in the market is, serious business. And again, whether it's for your personal account or your career, you should treat it as such. So with that, let's switch to GameStop. And I will try to go through these, as quick as reasonable, and I'll give sort of an example of where I saw this happen and why I put it here. So the first one is risk small to win big. Again, it gets to keeping in the game. I saw a lot of people in WallStreetBets me, like, I have $10,000 in savings. I just put it all in GameStop at $300 a share, right? That's obviously not a good approach. You really want to risk 1 to 2% of your capital, in any one investment. So for example, if you have $1,000, you take a $100 position, which is 10%, and you risk 10% on that. So you're risking $10, right? So that's 1% of your portfolio. And so that's how you really want to think about it. Obviously, don't bet the farm on one position, and certainly don't ride down your stocks 40 to 80%. You have to cut your losses. So number 2 is having an exit strategy. And this is kind of a bigger important one. Diamond's Hands is not an exit strategy. So Roaring Kitty, back when his account, obviously he's made a ton of money. His account went from $50,000 to $3 million, like sometime early January. And somebody asked him, he's like, what's your exit strategy? And he replied back, what's an exit strategy? Like, kind of, haha. And he clearly doesn't have an exit strategy. While he's made a phenomenal amount of money on this trade, he's not handled it well. So most people spend a lot of time looking at what stock to buy. Maybe they even spend months researching a stock. But most people don't have a plan for how to sell their positions. And it's less important what your specific strategy is. What is important is that you're consistent and apply it across, all of your trading and investing. And he wound up, and again, he's now up again because he added, and the stock has more than doubled since in like the last 3 days. But he rode down his portfolio because he had a big cash position, went down 70% from the peak of GameStop to, a week ago. I don't think it's quite down that much now, but you shouldn't be riding things down 70%. And he should have sold. Like, he didn't sell a single share when the stock went from 5 to 483. And that is an amateur approach to trading. So number 3 is don't get attached to a position. The more you tell people things about it, certainly if you're posting it online, you can get associated with a position and it gets harder to sell. So be careful, doing that. You don't marry a position, as they say, and you sell it and you could always buy it back. But just don't hold positions forever. Number 4, huge moves usually reverse quickly. So the move that we saw in GameStop is what people call a climax move, when a stock basically goes vertical over the course of a few days or 2 or 3 weeks. These moves usually do not last for very long, and they come crashing down and very quickly. We saw that with GameStop. It's now going up again, but 483 to 40 is a pretty large move. And there's no guarantee that it's going back up after that happens. So the next one, 5, this is another one of those sort of key points to take away from this, especially as I'm going through this quickly. So there's 2 here, A and B. It's not house money, it's your money. And the second is paper losses or losses. And so I saw even a Bloomberg reporter who, you would think is financially savvy, say, oh, it's okay that Roaring Kitty rode the stock down from 483 to 100 at the time that he said the statement, because he's playing with house money. So he's still up, again, these are ridiculous figures. And I apologize, this is not real life, right, for most people. He was still up 15 to 20 million, but he had lost $40 million. But it's okay because it wasn't really his money to begin with. It's not the right way to think about it. Any dollar that's in your account, whether it's realized or unrealized, is yours. You don't give it back. House money is not the right way to think about things. On the flip side, when you have a loss, but you haven't closed out the position. So this is a Davey day trader. I saw him the other day. He's like, it's not a loss if you don't sell. Don't sell. Stick with it. No, it's a loss. There's no guarantee that that stock price is coming back. And a lot of times the stock price does come back, and that's why people are afraid to take losses. It's like, well, if I take it here, it's going to come back, and then I'm going to look stupid. I'm going to be wrong. The reason you take the loss is because you're protecting from that stock that's down 10% going down to 50%. Every stock that goes down 50% started off at down 10%. And again, it's more important to protect yourself than try to reclaim a few percentage points. So those are two really key points about, handling your unrealized gains and losses. And again, this is a topic that you will hear a lot of people say, and in my opinion, it's just wrong. But again, anything I'm saying today, I encourage you to do your own research and come up with your sort of conclusion on things. I'm obviously offering my view. Number 6 is understand what you own. So I saw somebody post on Twitter, they said, why are my puts down when GameStop is down? They clearly didn't understand what they owned. And so stocks are fairly straightforward, but as you get into options and futures and other more complicated securities, things get more complicated. And so my point here is, if you're going to, venture beyond stocks, make sure you fully understand, the contract details and what affects the pricing of your securities. This person clearly didn't understand implied volatility and how it affected their puts. And the reason it was down when the stock was down is because implied volatility came down. And the 7th is beware market gurus. There's no gurus. There's no shortage of people giving opinions these days. It's even more than it was when I started. Obviously, with social media, everybody has an outlet. You need to be selective of who you're listening to, including what I'm saying today. Like I just said, I encourage you to take what I'm saying today, research it on your own, and make your own decisions. Don't just listen to me or anyone else who's saying something. You really should come up with your own conclusions. And sort of on this point, if we scroll down to the next page, Mark Cuban, who's the owner of the Dallas Mavericks, and I don't know why this happened, but he decided he was going to do an AMA on Reddit after GameStop had come down a considerable amount. I don't remember what the price was when he did this, but he was sort of posing as a market expert. And I would say there's a lot of meme investors who idolize Elon Musk and Mark Cuban and Cathie Wood. Not all of them are, in fact, market experts. And so here is some advice that Mark Cuban gave people about investing, which is mostly very bad. And I will go through that. So I took down 4 answers and I have them here, and we'll just sort of go through them quickly. So, and I don't have the questions, they're really not as important, it's just his statements. So the first statement he made is, when I buy a stock, I make sure I know why I'm buying it. Then I hodl until I learn that something has changed. The price may go up or down, but if I still believe in the logic that maybe buying the asset, I don't sell. If something changed that I didn't expect, then I look at selling. So the first part was actually good. I know why I'm buying it. Of course, you always want to know why you're buying something, or selling for that matter. Having your thought behind it, and it follows your trading plan. So his second point, then I hodl until I learn that something has changed. So here's where we go off the rails a little bit. You're usually going to learn about something after it's too late. There are a lot of people that get the news before you do. You have people who work in the industry that your stock is in. You have hedge funds who pay for flow of information from industry experts. You have mutual funds who get leaked information on the down low by corporate executives, or you even have Congress who insider trade legally, as well as the people in the company who are able to trade their stocks legally, even they know information. As this information leaks out, stock prices reflect it. So oftentimes, if you're waiting to hear it in the newspaper, it's already reflected in the stock price. And stocks can move a lot before it's out in the news. So the second part I sort of label as 3A and 3B. He's like, if I still believe in the logic, and is something that changed that I didn't expect. So he's using the word believe and expect. This is where we get into opinions. And again, holding on to your opinions can be dangerous in trading and investing. And, you need to realize that sometimes your opinion and your belief can be wrong. And so if the market is telling you that you're wrong, don't wait for the news to confirm or disconfirm your belief and expectations. I think it's better to let the market tell you you're wrong and get out quickly. Again, like I said, you can always rebuy the stock when it looks safer to do so. So his next answer was, if you can afford to hold the stock, you hold. And I think this was in response to people asking, what do I do now? I'm sitting on a big loss. I don't even know what this means. Like if I have $1,000 saved up and I don't need it to pay the rent or feed myself, I don't think I should just throw it all away in one stock. I could technically afford to lose it, but it's not a good approach to investing by losing it all, right? So you should always have your stop losses and keep your losses small. Afford what you can quote unquote afford is not a good benchmark for trading. So the next one he has, if you still believe in the reason you bought the stock and that hasn't changed, why sell? Well, I will answer his question of why sell. You sell because you might be wrong. And that's plain and simple. Sticking with something when it appears you are wrong can have grave consequences to your portfolio. If the stock goes down 10% and you hit your stop loss and you sell, it needs to go up 11. Your portfolio needs to go up, or your next trade needs to go up 11% to break even. If you go down 50%, you need to double to break even. So the bigger your losses, the harder it is to climb back from. So his last answer is, I typically don't set price targets on the upside. On the downside, when I was just getting started, I would set a stop loss at where my margin call would start. If you can afford to hold a stock that is going down, only sell if the reason you bought the stock has changed. So this is actually a good one, number 6, what I labeled here. So I typically don't set price targets on the upside. And this is good because stocks can run a lot further than you can dream up. I mean, look at the market right now. There are several stocks that are trading at prices that are not long-term sustainable, and they can still go up further. Like, you have no idea what the market can do. And so, let the market tell you when to sell. And if a stock looks really strong, even if you think it's expensive and it still looks strong and it's going up, you ride it out. Now, his second part of this answer is a little dangerous, to be candid. So he said he would use his stop loss. He would set his stop loss at where his margin call would start. So I will just refer you to what Fidelity.com brokerage, how they describe a margin call. They describe a margin call as a stressful experience with serious financial implications. It doesn't sound to me like that's a good place to put your stop. You have to get out well before that. So I will stop there. I recognize I went through these very quickly, but I wanted to leave plenty of time on the back end. I'm happy to go through any of these more in detail. Oh, I see you scrolling through the trading stats. If anyone's interested, we can go through that in detail. But again, so my goal here was, again, similar to last time, I've given you a lot of information. I've covered it quickly. If things resonate with you, do your own research and make your own conclusions, which you should be doing anyway. And, just sort of a larger point before I wrap up my speech. Sort of hit upon it earlier, where not even every or most investment professionals are well trained. You always want to be in control of your money, whether you're managing it yourself or giving it to an outside manager, whether that's a financial advisor or someone like Kathy Wood, who's running an ETF, right? So even if you're not doing it yourself, you are ultimately in control, and you need to be monitoring whether that outside person is basically being responsible and not thoughtful is not the right word, but managing risk and investing your money in an appropriate manner. Again, if you're doing it yourself, I would assume that you're doing it in an appropriate manner. But if you're giving it to an outside manager, you got to make sure that they're not doing things that are, too risky or crazy. And so, like I said, I'm going through all this, and it's incumbent upon you to really be in charge. And whether you're keeping it for yourself in your own account or letting somebody else do it, ultimately at the end of the day, you are in charge. And so, however much you want to get into your trading and investing on your own, reach a level of knowledge and proficiency where you can keep yourself from going through the issues that many people do, which is riding stocks or markets down, in huge percentages. So with that, I will open up the questions on GameStop or any of the rules that I said, or anything else that you have for that matter.
Awesome. That was really informative. I wonder, Callie, if you could maybe just share that screen again. Chris, if you don't mind, if we kind of just go slightly in depth on that break-even chart. I know we touched on it last time we spoke, but
Yep.
maybe just for the new people on the call, that
Yes.
would be pretty helpful.
Of course. Callie, did you want to put that up, or? So I can just walk through it. And I think this is, I lived it as a mostly long value investor at an institution. We didn't really pay much attention to this. This is really more of something that I would say traders focus on. But I think regardless of your time horizon or your strategy, you should always have this in mind. And what it basically means is, what does it take to break even based on how much you win, how much you lose on average, and how often you're right. And so if we just let's focus on the second column, which is I'm right 1/3 of the time. So, and this is over a large sample size, over 5 trades, anything can happen. But as you get to 100, 200 trades or so, I only need to be right 1/3 of the time if my average profit is twice my average loss. And so, I think a lot of misconceptions about investing come from the fact that people feel like they have to be right all the time or most of the time. And the analogy that trading and investing, or at least trading, long-term investors have a different view. I don't know, that's a whole separate other conversation. I'm not sure I agree with that approach. I did it. I saw what was wrong with it. I think being more trading-like can help everybody, regardless of your time horizon. But the analogy is more like baseball, where a 300 hitter is a really good baseball player, right? And I apologize if you don't follow baseball. So from a trading perspective, most traders are right. Your best traders in the world, actually, or at least a lot of them, are right less than half the time. And so I don't know if that's something that most people realize, because you're always like, oh, I was wrong in that trade. And you always want to be right. And I think the need to always be right can get people in trouble because it causes emotional and psychological issues to deal with. And accepting that, hey, I actually only need to be right 35 to 45% of the time, maybe even 20 to 30% of the time, depending on my strategy. And you can make a lot of money. There are people who have compounded at over 100% a year for like 15 years, and they're right 35 to 40% of the time. So you don't need to be right. You need to manage your average profit to your average loss. So again, you can see the win rate here and what it takes to break even. Obviously, you want to be better than that because you want to do better than break even. And the other important aspect I would say to this is keeping your average loss small. Think of what your standard deviation and your potential drawdown would be is if your average loss is minus 20%